Multifamily is one of the most popular asset classes in commercial real estate, in large part because it's very understandable. While most people haven't signed a 5-year restaurant lease or committed to an office space for their company, most people have rented an apartment and can wrap their heads around these properties. But even though the multifamily asset class might seem straightforward, there are a few things that newer analysts and investors often miss when underwriting multifamily deals. And in this video, I want to share 3 of the biggest things that I learned to look for when working for one of the largest multifamily investment firms in the US, and how each of these things can impact a real estate investment. So all of the things we'll talk about in this video are specifically related to what are referred to as the T12 and the rent roll, which are both very heavily used during the underwriting process. The T12 is short for trailing 12 months and represents a seller's profit and loss statement over the last year and includes operating revenue and operating expenses. And a rent roll is a detailed list of all the units at a property, including the base rent each unit is generating, any other monthly charges being applied to each unit, and the start date and end date of each individual lease. All of these things can have a direct impact on the net operating income a property generates, which will directly affect not only the cash flows an investor can generate, but also the value of the property overall. And when it comes to analyzing deals and making cash flow projections out into the future, both the rent roll and the T12 need to be analyzed very carefully. And for newer investors or first-time analysts just getting their start, there are a few things to look out for that are very easy to miss. And aside from general revenue and expense numbers, the first thing you want to put on your radar when underwriting a multifamily deal is the amount of bad debt incurred at the property. Bad debt refers to rent payments owed that have been written off by a property owner and aren't expected to be collected, meaning that some tenants ultimately didn't pay the landlord the total rent that was due. In most cases, multifamily properties will have bad debt that ranges anywhere from about 25 basis points up to about 3% of the total rent owed. And while these numbers might seem insignificant, this can have a major impact on the total revenue generated by a multifamily investor and ultimately the value of a property overall. For Class A properties in prime locations with top of market rents, you can typically expect this number to be on the low end of this range. For Class B properties in more secondary suburban locations, you can usually expect this number to be in the middle of this range. And for Class C properties in more tertiary, lower income areas, it's not uncommon to see bad debt on the very high end of this range or even above it. Other similar line items to look for that can provide insight into collections issues include things like late fees, cleaning fees, and forfeited deposits, since each of these things can give you a really good indication of when or if tenants are paying and how they're ultimately treating the units they live in. The key takeaway here is that even if you add up all the base rent on a rent roll, this doesn't automatically translate into how much rent you would actually collect as the property owner, and making sure you're keeping a very close eye on bad debt and collection issues overall is absolutely necessary when underwriting deals. Now, continuing on the revenue side of things, the next line item to focus on that can have a huge impact on the total income generated by a multifamily investor is concessions. Concessions are incentives or discounts offered by property owners to attract or retain tenants, and on multifamily properties, these typically come in the form of 1 or more months of free rent. And again, just like bad debt, a lot of concessions can make the rent roll show a very different total rent number than the total rent an investor could reasonably expect to generate over an entire 12-month period without these concessions in place. And because of this, multifamily investors will often focus on what's referred to as the net effective rent, which factors in these concessions directly and provides a much clearer snapshot of the average monthly rent that a tenant is ultimately paying throughout their entire lease term. For example, if a tenant signs a 12-month lease at $3,000 a month, but gets the first month of that 12-month lease free, their net effective rent would be calculated by taking the total rent they're required to pay over their entire 12-month lease term, which is $33,000 in this case, and then dividing that by 12 to get their net effective rent, or in this case, just $2,750 per month. And this net effective rent figure is a much more indicative number of what tenants are actually willing to pay to rent a unit and the kind of monthly rents you could expect to generate if you were to own the property and not have those concessions in place. You'll often see a lot of concessions on properties that are broadly marketed for sale because sellers and brokers know that this is something that's often missed by potential buyers that are looking only at the rent roll and the base rent values on that rent roll. The key takeaway here is that when you're analyzing a deal, if concessions have been offered for the last year and the seller has been offering 1 month of free rent on both new and renewal leases during that time, it's very likely that the rent roll you're looking at represents a number that's almost 10% higher than the net effective monthly rents you'd collect throughout the next 12-month period, and all of that needs to be factored into your underwriting going forward. Now, unlike the last two line items that we talked about, the final thing I want to mention in this video is not related to the revenue a property can generate at all, and these are major spikes in operating expenses that could signal bigger issues. Unexpected capital costs can be a huge drag on investment returns, and when big spikes in operating expenses show up on a T12, this can be a really big indicator that something might be off. Some of the biggest expense line items where this might be an issue are HVAC costs, electrical costs, plumbing costs, and roof repairs. And if you're seeing big spikes in any of these, especially if these are happening often, these could represent band-aid repairs by the seller that are covering up a bigger problem. Major issues with these systems can completely blow up or pro forma, especially if you're dealing with things like leaks or pipe bursts, fires related to outdated electrical systems, or heating and cooling problems that are extremely costly to fix. And unlike common area or unit interior renovations where you're making the property a nicer place to live and you're able to generate higher rents because of that, functional plumbing, electrical, and HVAC systems are all things that residents expect to come standard at a multifamily property and won't pay more for just because these are fixed. High expenses in these categories usually tell a story of what investors refer to as deferred maintenance or big repairs that the seller has put off, hoping that the next buyer would take care of these things. And when you see a lot of these expense spikes within a seller's financials, these are things that either need to be looked at more closely by your general contractor or in a property condition assessment report, or things that could even make you shy away from certain deals altogether. Ultimately, if you see a multifamily property advertised at a high cap rate and you think you can generate really high returns without much work because of this, you'll often find that one or all of these things will come into play. And if you want to learn more about multifamily investment analysis and how to build out a multifamily pro forma model from scratch in Excel, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on commercial real estate investment analysis, make sure to hit the like button and let me know. And let me know in the comments if there are any other multifamily investment analysis topics that you'd like to see covered in a future video on the channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.